Okay, look at those faces. All right, we got smiling faces joining in today. That's how you brighten up a Tuesday. Look at this. Let me go ahead. It's this right here. Couple things. Let's see. Oh, that's me. That's me. Hold on. Technical difficulties. I need to be pinned. There we go. Oh, okay. Julian, what is going on, sir? Thank you for joining in. Dan, Mike, Irish Rock Solid. Thank you for being on. Sarah, Iran, I think that is. I would like to welcome you. Appreciate you joining in. Chad, you are a repeat offender, man. I think I saw you last
Two
week.
in a row.
I know, man. I got you covered back. That's good stuff, man. Glad to see you here. Hope you all had a great holiday weekend. I know I did. I ate way too much stuff, way too much barbecue. But it's ending. I'm getting myself on the straight and narrow path now. So I'll be back on. But let's go ahead and hop right in. So today we're going to be talking about syndication structures, right? How to structure your deals. Some of those might be passive, like my man Marcus House. What's going on, Marcus? As a passive investor, you want to know what sort of structure you might see as you're looking into an investment. As an active investor, you also want to know how can you structure a deal, how can you make your numbers work out. And so doing that, you need some sort of sophistication. That's what we're going to be talking about today. So we'll be going into detail. I hope you all have questions. If you've got something right now, if you've got a question that, you know what, I showed up to understand this thing, go ahead and put it in the chat right now. So I know I want to knock out questions and make sure that I'm providing value to people's here. Look, you took time out of your Tuesday to show up, right? If there's something on your mind, something pressing on your heart, you've got this apartment thing going on, this burning sensation of questions that you need to get answered. Now is the time for you to get those things answered. So feel free to just hop in, ask those questions right away. Let me go ahead and start off with a brief intro. My name is Jason Stubblefield. I've been investing in apartments since 2015. I've been a general partner in over 1,000 multifamily units. You should be seeing can I get a head nod if you're able to see my screen, the SNS Capital Partners? I think I did that right. Okay. So this is my website here. You can find a little bit more about the assets that we bought, the assets that we will be buying. If you're interested in hearing about the investments that we have, you can go over here to the Invest tab. That's a brief form. This will put you in our community. We got a deal that I'm excited about right now that we're having a live webinar tonight to talk about the details of that deal. But if you did not hear about that deal, suppose you haven't filled out the form and you're not on our list. So just a brief form takes 5 minutes, and that'll get you included if you want to hear about investment opportunities. Okay. So I'm back now. Let's go ahead and dig into it. For this, we're going to have to hop into the whiteboard. So I'm gonna try to get my whiteboard working. Well, I got my handy dandy pen here, and let's go ahead and dive right in. So splits. If you've got capital and you are deploying that capital into a syndication, or you are an active syndicator, or you're putting a deal together, how do you know how much money to give to you, how much money to give to the investors? How are you going to split this thing up so that everyone benefits? And this is the key of making deals done. You know, we've been in a hot market right now, and as this market has progressed and deals have become more and more attractive, you had multiple bids. It's been the structures, it's been the debt structures, it's been the equity structures, it's been preferred equity, it's been preferred returns that have really gotten sponsors over the hump, right? How do you eke out that extra 100,000, that extra 200,000 in purchase price and still make numbers attractive to your investors? And what happens is a lot of people, they don't understand this type of stuff. So they take an old business model and try to put it into today's market and try to go out and buy a deal, and you keep getting outbid, you keep getting you keep losing a deal, or you're best and final, but you never get there. And it's because a lot of the groups that are buying deals are using some of the equity structures that we're going to talk about today in order to make their deals pencil and to make them attractive to their investors. So let's go ahead and get that. Mike Penny coming in with the question, curious how the depreciation and other tax incentives work for both GPs and LPs in syndications. Well, I can answer that relatively quickly. The depreciation is split right along the lines of the equity structure. So I'll go into the first structure that we'll cover today, which is a simple split. But if you split a deal 50-50 between the operator and the limited partner, then the taxes flow down right according to that structure. So 50% of the tax benefits go to the operator of that deal, the sponsor of that deal, and 50% of the taxes will go to the limited partner or partners of that deal. And that gets, say you've got 10 people or 10 in limited partner investors that make up that 50%, then however that is divided up amongst those investors, that's how their tax percentage will flow down. So if you are 20% of 50%, then that's how your structure will work. And so hopefully that made sense to you. If not, we can talk about it a little bit more. So let me go ahead and go over to the whiteboard, share the screen here. Boom. Let's get into it. Ron, as an aspiring multifamily investor with limited capital, how do I go about joining limited partnerships for syndication of deals in my area? I live near the Tampa, Florida area. Yes, joining network groups like this is definitely a way for you to network and get yourself involved with other limited partners. If we have time, we get to it today. One of the things that we've done is we have allowed people to sort of share, right? At the end of this, depending on how long we go, we have like a needs and wants section, and there's plenty of people who sponsor deals themselves. You can connect with them in this community. If you're in this community, that's fine. I've also got a Facebook community. There's a lot of activity going on over there, and through that, you'll find more sponsors in your area, right? Okay. And I also sponsor deals. It's not going to be in Tampa. It's not what we're buying right now, but it's in the Atlanta metro. So if you're interested in something maybe not necessarily in your backyard, then you can reach out to other sponsors who may not be in Tampa. Okay. So did I show a whiteboard? Are you all able to see the whiteboard? Is that a yes? I've got so many screens over here right now. Can you all see the okay? Yes, you all can see that. So let me get rid of this. Okay, so erase that up. All right, so let's go. Right now, I'll dig in. Continue to drop those questions if you got questions that I'm not covering right now. And what I'll do is I'll go back and get them. But we need to get into this. So that's not what I want. I need to be able to draw. And what's happening? Bear with me. I lost my pen. Where my pen go here? We'll find it. Okay, let's just stop that and then go back. All right. This. Okay. Now I got my pen, and I got all these screens that screwed me up here. Okay. So basic split. Let's go ahead and get to it. So We'll walk through an example. In this example, we've got an NOI of $10,000. Okay, so net operating income, that means after we collected all our rental checks for the month and after we paid our property management company, our taxes, our insurance, whatever, the NOI on our sample property today is going to give us $10,000. And so we want to talk about how we're going to split this $10,000 between our general partner. And just a quick reminder, general partner is the one who is sponsoring the deal, who found the deal, who's managing the deal, and you have limited partner, right? And those are the people who are invested passively, all right? So how are we going to split that? One of the ways we'll split that, this is just basic structure of a split. And one of those is a 70-30, right? So very typical, right? 70% will go to the limited partners and 30% will go to the general partners. Usually the general partners get more, they get the lion's share of the deal, because in this business, you have two customers: the customer of your tenants who you are serving, and then you also have the customer of your investors, right? And you have to please both of them. So if you do not make your investors happy, you will not be in business long. So the first thing you have to do when you're structuring any deal is think about who's going to invest in this deal and how are they going to profit from it. So given that said, you want to make sure that however you split a deal up, it is attractive to those people who invest into it and that they're going to be able to earn an amount of money that is acceptable to them. Okay, so with this, we got a 70-30 split. So out of that $10,000, the limited partners will get $7,000. Okay, very simple math here, right? They're going to get 7,000, and then the general partner will take the remaining 3. All right, so any questions about that? That should be easy enough. So out of that $10,000, you say, I found that deal, I'm running that deal, you're going to make $3,000 a month. 7 grand is going to go to the limited partners. And that's a basic structure. And you can divide this up however you want to. You can do 70-30, 75-25, 90-10. The only thing I would say is that
Jason, are you maybe I'm getting confused here. You said GP on the left, LP on the right, and then you're saying 7,000 to the LP and 3,000 to the GP. Is there? I want to make sure that's what.
Yes. Yep. You got it. That's it. So just to clear it. So general partner, that'd be, I'm screwing it up. This is your limited partner. I probably should have titled it differently the way I wrote it. And this is your general partner. All right. So this is the person who's running the show. These are the people who are invested passively. And you're going to split that up right there. So thank you for that. Let's get it clear. Okay. So that's really all it is to it. So what I was saying is you can split this up as an 80-20, it's a 75-25, 90-10, 95-5, whatever you choose to. But as a sponsor, you want to make sure that whatever you're doing is worth it to you. Now, if you got to give 90% of the cash flow away, right, you want to make sure that the amount that you're keeping is worth it. Okay, just side note, you don't want to necessarily work for free or work for pennies, because this is a job to be done. All right, so that's the basic structure, just 70-30. All right, and let's now go to what's next is what you'll have, a preferred return, and we'll show you how the differences in between these. So still keep the same NOI, $10,000 a month, but now we're going to have a preferred return. Okay. And so this preferred return, what it says is that I'm going to give my investors a certain amount of capital based on what they invested prior to anyone else getting money. So out of this $10,000, we're going to almost, I don't want to say the word guarantee. That's not what I'm looking for, but we're going to give preferential treatment to the limited partners in a certain dollar amount. Okay. And so in this example, let's just say we have a preferred return, abbreviated as PREF, of 7%. Okay. So we got the same $10,000 of net operating income, but now we're going to do a 7% PREF. And let's just say that we got $500,000, right? We raised, our limited partners gave us $500,000 at a 7% pref. I just do this math. That's $35,000 a year, right? So the first $35,000 of income is going to go to the limited partners, right? So let's just say at $10,000 a month on the yearly basis, this property would make, just follow me over here, this property would make $120,000 in net operating income. And really, just bear with me. There's other expenses and debt, whatever. We're just saying that the money we have that actually should be cash flow instead of NOI. But we say that it makes off $120,000, and now we're going to say the first $35,000 of that is going to our limited partners preferred. Okay. So we're carving out a section of this capital, and we're saying we're going to give that to our partners ahead of time. And so let's see how that looks on a monthly basis. I've got to change it because I don't, it's gotta be right. Take that off, and let's just say, right, we got cash flow. Cash flow here. All right, cash flow is $10,000 monthly. Now we got a 7% pref, and we said that, just made it up, but $35,000 goes to our investors. So roughly, approximately, on a monthly basis, $3,000 would need to go to our investors first. So out of this 10 grand, we would take, and basically I took the 35,000, I rounded it to 36,000 to make the numbers easy. Then I divided that by 12. So we're just looking at a month here. And now in that month, we're saying that $3,000 of our income is going to go to our preferred return to the limited partners, right? So stack it all up, you got the $10,000 of cash flow. Now I'm going to take the first $3,000, and that's going to go to our limited partners. Okay. And then that is going to leave 7 grand in additional money. And then out of this additional 7,000, now what are we going to do? We're going to keep that on a 70-30 split. So how does that look? So we got this 3,000 is assigned to our limited partners. And out of the 70,000, we're going to split that on a 70-30. So that would be $4,900 that will go to our limited partners. And then there's $2,100 left over for the general partners. Okay. So if we total all that up for a limited partner, this is how it goes. Right. So they would get initially $3,000. That's their preferred return at 7% on what they invested. And then they would also get $4,900 in the 70% that's left over, for a total of, can I do math here, $7,900, right? So if this is with a pref, okay? So on a pref, the investors got $7,900. Before the pref, if you remember, we just did the 10,000 on a 70-30, our investors only got $7,000. And this is looking at 1 month, right? So if you're following me, right, and this is basically we took 10 grand, our total, right? And then we gave them 70. I need another zero there. Then we gave them $7,000. Okay, so that was our investor total before. Now they got the two, right? They got the 3,000 and the 4,900. Just everybody follow that. All right, I want to stop here just to make sure I don't lose anybody if you're new to this. You just got to bear with me with this this chicken scratch here that I got on the whiteboard. But I'm working with it. Let me check the chat. I think we are.
So
I think we're okay.
How
Yes.
much was the preferred investor's investment? How much did he invest? Like, what's this? You said 7% is three grand, right? So let's say I am the preferred investor. How much
Yes.
did I give it to you in the beginning?
Yeah. So we started off with a limited partner investment of 500,000. Okay, at 7%. So if we raise $500,000, is that it? I need another zero. So we raised $500,000 and we wanted to do a 7% on that. That would be $35,000 a year, which is what we did here. Now, I didn't want to go ahead and do the math and make all this funky with a bunch of decimal points or whatever. So I rounded it to $36,000, right? Just say we raised a little bit more money than 500,000. And at 36,000, that's $3,000 a month. So you with me there? How we got to that?
Yeah.
Okay, gotcha. So Aran, and please, if I'm butchering your name, I apologize for that. No, correct me. But he asked, where did we get this $4,900 from? All right, and so let's go back over that. Oh, I got it correct. Good. So it was a comment. He commented that I did pronounce his name correct, but you asking about where we got this $4,900 from here. So on this, we're doing preferred return. So preferred return, right? We say we have a pref that is going to be this $3,000, right? $3,000 is what we're giving our investors before anyone else gets their money, right? Before any general partner takes their money, we have a preferred $3,000 to our limited partners. So assuming we made $10,000 a month, we're going to take $3,000 and give it into the investors. Okay. So now, once we deduct their $3,000 off, now we're only at $7,000 left. Okay. Out of that $7,000 are split, right? What do we do with the remaining of the money after the preferred return? Well, we kept that just like we did in the beginning, right? With our 70-30 split. So out of this $7,000, now 70% of that is also going to go to our limited partners. And so that's where we get this $4,900 from here, right? So $4,900 here, and then they had the prep here, and then we totaled it up for a total to our investors of $7,900. Now, you see how we're taking the same amount of cash flow, same 10 grand, and to the investor, they went from, in example one, only getting $7,000 a month to getting $7,900 a month. And now, if you are calculating that, it's more attractive to limited partners because now they're making more money. So does that make sense, Ron? Did I answer your question? Hopefully so. Okay. So I believe so. Cool. Just stick with anybody else, because here after this we're gonna get nasty with it. We're about to do some we're about to do some more. This is one basic split, and just bear with me with the handwriting, but if you're following me here, hopefully this is okay. So
yeah, so one last time, right? So I got the left side clear. On the right side, 4,900, that's also clear to me. That's going to LP. And then the $3,000 is also going to LP, limited partner, but that 3,000 is going to that one guy who wrote me a $500,000 of check, right? But the 4,900 is going to maybe 7 guys who gave me $50,000 check each, correct?
No, I think you're getting it confused a little bit. So I'm treating the limited partners as one entity that all gave 500,000. So it could be one guy that gave you 500,000, or it could be 10 guys that gave you 500,000. Doesn't matter, right? This is how it's going to be split.
Okay. So then in that case, then the limited partner is taking 7,900 and me as GP is making 2,100.
Correct. Yep.
Okay. Got it. Okay,
Yeah.
I was kind of thinking the other way, which may be a possibility also. So I'm just gonna throw a scenario here, right? Let's say I'm trying to raise $1 million from the market. Here is this one guy, Jason. He wrote me a $500,000 check, and he said, "Don't treat me like anybody else. Treat me special." And I say, "Okay, I'll give you preferred 7%." While the other guys gave me $50,000 each, and those are 10 guys. I'm not going to treat them preferred. I'm going to treat them a normal 70-30 split.
Yeah. So you're getting into where I'm going now, right? Which
Okay, all right,
which is
okay.
the next example, right? So we'll
All right.
cover that. We'll cover that scenario, right?
Right. Okay.
So
All right, got it.
before I get rid of this, anyone else have a question about prefs? Okay, and then let's go ahead. Let's see if I can clear it out. Can I clear all this at once? I'm pretty sure I could, but just bear with me. I mean, I want to get rid of all of this. Okay, so we'll keep a lot of this the same. And now we want to get into what Vikas was just talking about, which is you have preferred return, which we just covered, but you also have preferred equity. And that's what he was getting at. Basically saying if somebody cuts you a big check or bigger check, maybe you give them more than you would give someone else, right? So that's preferred equity. So we'll keep this. We're still going to have a pref of 7%. But what we also might do, what we also may do is we may separate our investors into classes. All right. And so you'll have like a class A, right? And we'll say class B. Okay. And so class A, we'll say we'll keep this class as the people who have given us maybe they gave us a dollar amount. Maybe the minimum investment was $100,000, or I'm sorry, the minimum investment was $50,000. But for all those people who will give me $100,000 check, I'll give them a different sort of class, or it could be 250,000 or whatever it is, right? And so because of that, the way you can structure it is you'll have class A and you may give them an additional bonus, right? So class A, I say all my class A people, you're getting 10% on your money. And I'll say my class B, you're getting 7% of your money. All right. And we sort of hinted at this, but class A versus a class B is where you're going to take your investor base and you're going to put them into a class based off something that they do. It could be the fact that they wrote a bigger check. It also could be that they don't want to participate in any upside, right? And you say, well, why would an investor not participate in any upside? Well, people who invest have different reasons or different things that they're trying to accomplish. So as an investor, if you really just wanted to preserve my capital and you're investing in a deal, say, you know what, I don't care about the upside. I don't care what you sell this building for. I want you to get 10% on my money, and I want that money coming in first. This is what we call preferred equity, right? So pref equity. And usually they sit higher. They sit higher in the stack. So let's talk about the stack. So we'll have our debt. I'll put it up under here, right? Debt, that's the head honcho. That's the bank. Got to pay them, right? And then underneath that, we'll have our preferred, our pref equity. I'll just abbreviate that as E, right? Preferred equity. And they're going to get 10% on their capital. Come on. Get over here. So they're getting 10% in the preferred equity. Okay. They're down there. Look at that screwy box. And then you'll have everybody else, which is just your limited partner. And they may get 7%. So what does this do as well, let me finish explaining this preferred equity piece. So when you have preferred equity, what you're saying is these guys right here, if something were to go wrong in this deal, when we sell or when there is cash flow, any cash event, they're going to get their money first, right? So they are in first place, right? So they're going to get 10% on their money first, and then everybody else has to take what's left over at 7%. All right. So if the deal went bad, you could say that there may not be any money for the limited partners of 7%, and only the pref equity would get paid. So that is a benefit to them. For that benefit, they may choose, or you may structure the deal to say, you're just going to get 10% year over year, but you don't participate in any upside. And that is attractive to some investors. So if let's talk about what that does for a deal. Because that class of investor, right? That class of investor is not participating in any upside. What happens is that we're able to give a juicier return to this 7% investor, right? So let's say we make a $1 million on this, but the 10% people, only thing they got out of that $1 million was their regular 10% return. We paid them that, but now all of our 7% people, they get more upside. So it's structures like these. It's doing these sort of equity splits that have really allowed tight deals to become juicier to other investors, right? Or to be able to eke out returns or to increase offer prices on properties, because you've got a unique structure that allows you to take the same money and manipulate how it is distributed in order to make your offer better, right? So for this return to an investor, right? Say these people gave you $100,000, right? I just want to make sure this is clear, as clear as it can be with this handwriting of mine, right? So they're going to get 10K year one and 10K year two. Come on. Get over here. Right. They're just getting 10K every year. Okay. That they're in the deal. They just get their 10K. So this is 1, this is 2, this is 3. Really simple, right? And then you would have, I don't know what this thing's doing. It's irking me though. But then you would have, I'll get rid of that. Your 7% people, and they may get, they're getting 7% year one, but they also have upside. So I've got to stop touching this button. That's what I'm gonna do. Here, boom. Okay. So they're getting, say, 7%. And then maybe in year two, there's more cash flow because you're doing a value add, and maybe they get 8% year two. And then maybe year three, they may get 9% because you're doing value add. All right. So their cash flow is different, right? Off 100K, that would just be 7,000 year one, 8,000 year two, 9,000 year three. But they made less money than these people. But when you sell, now they get more upside, right? And so if you're with me, hopefully you understand how you do these sorts of things in order to make your deals stick out. So I'll stop right there. That's the preferred equity structure there. So you've got your preferred return, and then you've got preferred equity. And so even with this structure, all right, for those who are with me, when you get to the limited partners at 7%, they can even still have a preferred structure, right? So this could be preferred equity all up here, and this could be preferred return here in this, right? So
So,
Correct.
Jason, when you take money from the bank, by all means, bank tries to make sure they are the preferred, because if something goes wrong, they want to auction it and they will be the first one to get paid on the debt, right? And they would be the first one by all means, right? Correct?
Always. Yep. Always.
Always.
So yeah, they sit here on top, right? This is the head honcho right here. All right,
Yeah.
they're the king, right? The debt.
So,
But
so
after the debt, how
yeah.
everything else flows is to preferred equity, then preferred returns.
So basically, then the hard money lender or the bank would be on the top, always takes it first. Whatever is left after serving their debt. So what would I be called? Will I be called Class B share? Because there can only be one Class A share, right? That would be the bank. They won't let me be a Class A share, would they?
In this scenario, we don't even consider the debt as a class. The debt is mandatory, right? So when I talk about Class A and Class B, right? This is your Class A right here, right? And then this is your Class B, and we're not putting the lender in this, right? The lender is different. The lender is not a class, because Class A and Class B, neither one of them get any money until after the debt is paid.
Okay.
So we're only talking about cash flow here, right? And I may have screwed you up when I called this NOI, but this is cash flow. So this is after the bank, after you paid your mortgage premiums, all the other stuff, right? What you have left to distribute is that's a funky H, but anyways, you get what I'm saying. That's cash flow.
Okay, so basically lender is always paid first. After that, whatever is left, that's going to go to Class A or Class B shareholders.
Correct. Yep.
Wow. Okay.
Yep.
Okay.
You got it. Cool. So that monstrosity of a handwriting is how I explain all this. So Jeff asked, how much is the initial investment for the LP? In this example, we just assumed limited partners gave us $500,000. And so that was it. And we did some rounding in there too to make that 5,000 basically their preferred equity, 36,000 a year with $3,000 a month. Okay, so check it Facebook. Let's see. Is everybody okay over that? Boom, boom. Let's see. All right. Yeah, multiple investor classes. We got through that. So the main takeaway I want you to get it is one, understanding how those things work. Two, understanding that what I've done and what I've seen done is some real financial engineering when it comes to deals. And so if you understand how to do this, you can take one deal that's going to kick off a certain amount of cash flow and turn a borderline deal into a very attractive deal. Or you can take a mediocre deal and probably get it up to standard, right? And what happens in a competitive market like what we've been in is that structures like this is what has allowed people to win deals. So if you're in a bidding war and like, hey, you can win this property if you gave the seller extra 100 grand. Understanding those debt structures, how you get them extra 100 grand, right? Understanding how to do that is how you can have strong returns to your limited partners. Take preferred equity, and you can really do it, especially when that preferred equity is treated almost like a second loan on the property because they're not participating in the upside. It really allows you to move some money around and pay your investors and make deals work. So if you're investing passively, understand that, and these structures have gotten, some of them get more and more unique to each one. We have people they got multiple classes, they got a A, a B, a C, depending on what they do. You'll see that, but hopefully now that you've listened to this, you're at least understanding what's happening. Sarah has a question. When trying to raise money through syndication, do you need to file with SEC? Absolutely. It's required. If you don't do that, you could go to jail, and nobody wants to do that. So cool. Cool. If nothing else, no other questions. I hope that was all clear. Appreciate you all today for hopping in, taking this time to go over something that it's a little bit complex, I guess. Once you do it a few times, it's fairly straightforward, but just something for you to know. And what type of investors can do this type of deal? What type of investors? Almost any type of investor can do a deal like this, right? You're talking about what Sarah's asking is what type of investor can do the deal, or whether they can have to be accredited or non-accredited. When you talk about accredited versus non-accredited, now you're talking about the class of structure, whether it's a 506B according to the Security and Exchange Commission, or a 506C, right? And that's where you get into, is this an accredited investor or not accredited investor? I could probably do I could definitely do a whole nother webinar just on B's and C's and how that works. Just know that this structure doesn't, the way we split up equity today, doesn't matter what type of regulation you file under the SEC. So you can do this with a 506B, with a 506C, with a Reg A, whatever you're doing, right? You can do that. This is just how you split up the pie, right? You got some money coming in, you split the pie up in these ways. All right, hopefully that answers that question. Cool. So that's it. Just hit it again. I'll be on a webinar tonight. You'll see how we I should do a disclaimer. Maybe, I guess. Probably should. Hey, Jeff, we'll talk offline about that. But for those who are in, I know Sarah's asking about the webinar. Yes. So tonight I am doing a webinar. It is a 506B. So you have to be in our network. We have to have a pre-existing conversation with you. If you want to hear about our investments, snscapitalpartners.com. There's a join button, right? Joining there that allow you to hear about our investments. You'll be able to see what we're doing right now, live structure, how we're splitting up equity, what we have rolling out, and it's an affordable deal. So it's pretty, it's pretty attractive. I'll say that I'm excited about it. But because it is a 506B, can't just share the details and tell everybody what I'm doing right now. You need to be in our list and in our database to make sure that I don't go to jail, right? So we'll make sure that we're staying compliant. But yeah, so definitely encourage you to do that. Let's see, I'll put our website here, snscapitalpartners.com. And if you go through that, Sarah, and you fill out a brief form, that'll put you in our database so that you can hear about future deals. Other than that, I'm signing out. I hope that you all got information about this. You're definitely welcome, Mike Penny. Hopefully you can take this stuff and use it. For those who are new, for those who are trying to figure out how to put this together, or they're trying to scale their portfolio, I do got a program. If you're on the Facebook group, you know how to reach out to me. So if you want help trying to structure your deals, you want help trying to get started in the business, then reach out. We'll have a brief conversation to see if what I have is a good fit for you. Other than that, I appreciate your time today. It's been real. You ain't got to go home. You got to get out of here. The multifamily code is what it's called, Iran. Yeah, that just, if you put that in Google, or at least go to Facebook. It may not be in Google yet, but if you go to Facebook to search for the multifamily code, you should see it there. All right. Thank y'all. I'm signing off. Take care.